All right, guys, welcome. We're going to talk today about navigating the market, some trends, tactics, timings for your financial strategy. So a little bit about us. We're Pitt Capital Group. We really mainly deal in investment management. We have in-house investment decisions. That's Chris and his team, so he's in-house. We've taken a fiduciary approach. We have boutique feel, small dedicated teams that work directly with an advisor. We take a holistic financial planning approach for wealth management, business consultation, and 401k planning. We like to say that we have exceptional client service. Like I said, again, holistic financial planning approach with transparent investments. A little bit about me. I'm Matt Villers. I'm one of the financial advisors here. I'm a certified financial planner and have my master's in financial planning. Outside of work, I spend a lot of time with my wife. I have a 1-year-old son. We love spending time with our dog, doing stuff outside and just things together as a family.
My name is Christopher Barto. I am the Senior Investment Analyst here at Pitt Capital. I assist the CIO and our Head of Asset Management in investment decisions, business investment decisions, and occasionally meet with clients to talk about their portfolio.
Great. So how to interact, I mentioned this a little bit in the pre-meeting, but if you're on a mobile device, you'll see a little Q&A button at the very bottom right there. You can click it up, type in a question, and we'll get to see that on our end. If you are on a computer or desktop, same thing. There's a Q&A button at the very bottom of your screen right here. Type in the question. We'll see it. We'll answer questions here at the very end of our discussion, trying to cover as much of the topics and lumping some of them together as we can. So really today, just want to talk about investor mindset. I know a lot of people get a lot of questions about day trading versus long-term investing. If you had to describe, Chris, kind of the day trading versus long-term investing, just tell me a little bit about that, what you're seeing.
Yeah, so day trading is kind of exactly what it sounds like. Most of these traders are focused on the day-to-day action of the market or the individual security or asset that they are looking to trade. It is higher risk. There is higher risk, higher reward, but also there is the risk of capital loss or permanent risk of capital loss, which we are very against.
Yeah.
And in our view as long-term quality investors this is more akin to gambling in our view. We think that over the last few years, and it's gotten worse every year, over the last decade, 2 decades, the gamification of the stock market in recent years. And you're seeing it in moves recently, as recent as Beyond Meat. I don't know if you've seen, but I think it's up around 1,200% in the last
oh my gosh,
4 days. So there's some froth out there in a basket of certain securities. And those are the type of that's basically day trading in our view. I think that's a great example, actually.
Yeah.
The Beyond Meat that's been happening, and kind of the Oklo, $20 billion market cap with 0 in revenue.
Yeah.
It's a little reminiscent of the early, tech bubble back in the late 90s. But drivers of this are really short-term news flow, headlines, tariff news, which we seem to get every single day somehow. I don't know why or how, but we do. Earnings plays and geopolitical events. And, it causes a lot of stress for some people, whether they would like to admit it or not, but it also creates opportunity for us as long-term business investors.
Yeah, no, that's great. I think back to 2020 during COVID, all the different people that were getting into day trading, they had nothing else better to do. And I think that created some trends, it sounds like. We're obviously not doing day trading in clients' accounts. We are active managers, but we would consider ourselves long-term investors. Tell me a little bit about our investment approach at Pitt and how you guys manage portfolios.
Yeah, so we are heavily in favor of understanding businesses that have quality. And, quality is a factor in the market. However, we think that a lot of people misunderstand what that word really means. And, how we kind of look at it over the years is we're looking for companies that have durable, strong top-line growth. Those kind of companies that can maintain pricing power in inflationary environments, continue to gain market share, continue to expand their margins, gross margins, EBIT margins, net income margins, free cash flow margins, and then really focused on the quality of their capital allocation plan, whether that's share repurchases, bolt-on M&A if they paid the right price for it, and dividends.
Yeah.
So, there's a lot that goes into a quality business, and we feel, I mean, obviously, we want to have a good grasp on that. If we feel like we do own a lot of good quality businesses. Um, free cash flow at the end of the day and earnings quality is what will drive your returns long term. And when I say long term, I'm not talking 1 to 2 years. It could take 3 to 5 years to 7 years for an investment to play out.
Yeah.
And we've seen that a lot over the last 5 years where, you have since 2022 and the tech CapEx AI build out, a lot of those larger cap tech companies, they coined it the Mag 7.
Yeah.
Tesla's in there. I don't know why, but you could call it the Mag 6
Yeah.
or Mag 7, including Tesla. And you have those companies that pretty much drove a lot of the returns, and a lot of companies got left in the dust. And we think there's a lot of opportunity outside of technology. Not saying that there isn't opportunity within technology, there most certainly is. But there's a lot of stuff that's been just underperforming and, trading day by day.
Yeah. Yeah. It sounds like we really just want to take a disciplined approach, making sure we're investing for a full business cycle, like you said, the 5 to 7
Yeah.
years, making sure we look at companies with really strong balance sheets
Mhm.
and just have a disciplined, long-term approach. And I would agree with that. I feel like that's when a lot of people start to make mistakes. We, as financial planners, a part of my job is creating guide rails for these clients. So we set up an investment policy statement. We know what we're investing towards. We're
Mhm.
defining clients' goals. We're creating an investment plan. So that way we can avoid big emotional decisions. We're not
Yeah.
chasing those headlines like you're talking about,
Yep.
just throwing money into tech when it could be really, really risky.
Yeah.
As well as being aware. I mean, one thing I think a lot of people miss whenever they start to day trade and they do all this in brokerage accounts is tax consequences as well. A lot of people are day trading and they don't realize that every single time you buy and you sell something and at a gain, you're creating a short-term gain, especially in a brokerage account, not necessarily in a retirement account. But you're paying a higher tax rate at that versus capital gain, long-term capital gains rates, which are a lot lower. In talking about today's market drivers, I know we got to talk a little bit about day trading, but it seems like there's so many headlines populating today from everything from government shutdown. We know with the administration, they pump out a bunch of news. There's so much stuff moving around in the market. What do you think the main market drivers are today, and how do you think that your team utilizes those in investment selection?
So we can break down market drivers to day by day
Yeah,
or long term.
gotcha.
Day by day, we're being driven by, a lot of the Fed comments. We're, rate cut decisions. We're going into earnings season now, so I do think that you're going to see the market be driven mainly by earnings, which hopping into the long term, that's what drives markets long term is earnings growth, free cash flow growth. Those are the core drivers of a good quality market over the long term. And, we're seeing tariff talk pretty much every single day. I mean, the T word gets thrown around every single day.
Yeah.
And if you want to rewind, when the reciprocal tariffs originally went on back in April, the market dropped, wow, what was it, 10, 15% in a few days. And this is kind of where that difference between being a day trader and a long-term investor really comes into play. Because those geopolitical risks, they're always there. They're always, no matter who's president, no matter who's in the administration, they're always going to be there. And that's not just in the US, that's in Russia, China, Europe, everywhere. They're always going to be there. And you have to be able to kind of positive and negative. So you have to be able to look through a lot of the noise and focus on the data that matters. And the data that matters to us is investing in good quality businesses. So, people are worried about the return on investment in all the large cap tech CapEx that's happening. But I think we haven't really seen a build out like this outside of, fiber optics maybe in the 90s. And people are worried about the ROI, but I think they fail to realize that we're only 3 years into this. So I don't even know if it's peaking now, but I do know that those big tech companies have profitable businesses
Yeah.
outside of this already. I mean, they're the leaders of the market. They're the biggest and best, and they have the best capital allocation programs out there. And it comes to a point where you have to trust management.
Yeah.
I mean, Zuckerberg's come out, Sundar's come out, and it's like, oh, if we're over investing, well, we don't want to lose the AI race. We might be over investing. I mean, that news is already out there.
Yeah.
So you have to trust management to an extent, and you have to position your portfolio accordingly. I mean, you don't want to be 50% three names,
Of course.
and then things don't work out and they're down 40%.
Yeah.
So we think there's a lot of attractiveness outside tech too.
Yeah. In from a planning perspective, I think you bring up some really good points. We see so many people did bet correctly on the right companies that might have over concentration in portfolios. And we'll talk about diversification, I know, here in a little bit, but that's something that we can help out with clients, is figuring out how to diversify from some of those big names, because they did pick the right Meta or Nvidia at the right time.
Right.
But there's also other types of market drivers as well. Cash reserves is a big thing that can help prevent the negative side of those market drivers. So like we talked about with tariffs or the government shutdown, we have clients that may have worked for the government or worked for government adjacent businesses that are getting furloughed or laid off at the time. So we want to make sure that we're not just investing for them, but we're also planning the right types of ways so that if they do get furloughed or laid off, they have a cash reserve to plan with, as well as spending flexibility in these times. Well, like you said, in the market's up right now. In April, if somebody needed to withdraw money to purchase something large, like a car, like a home, we want to make sure that we create the right type of plan and spending flexibility into their investment strategy to deal with those things. And I know we'll talk about asset allocation too in a little bit, but that seems to be the main risk driver from that standpoint: how much stocks and bonds, how much risk assets and defensive assets that you have. But we want to make sure that asset allocation matches what level of market volatility you're willing to take, both from a willingness standpoint and what you're able to take on as well, to really match it with your goals.
Yeah.
There's a lot going on with global signals. I know you guys spend a lot of time on the investment selection. How do you guys really look at all the different factors affecting the valuations of companies and the investments that somebody should purchase? How do you know what signals to look for and what's noise and what you should look for?
Yeah, I mean, this segment could probably be about 40 minutes.
Yeah, probably.
So I'll try to break it down. But after a decade of kind of figuring out your approach to investments and how to invest, what to invest in, you sort of start to break down what's important and what's not. You have to be able to ignore the noise.
Yeah.
And I think what's kind of an interesting point is, in recent weeks, the government's been shut down for what, 22 something days now?
Yeah.
And we haven't gotten some economic indicators, and guess what? The market just continues to chug up.
Yeah.
So I think when you take it from that perspective, there's a lot of economic indicators out there. There's a lot of different global data points that we can point to and be like, oh, well, that's not good. We should probably sell some stocks. Oh, well, if these two are correlated to a market downturn, we probably shouldn't have exposure there. I think it all comes down to what the business is at the end of the day.
Yeah.
And you have to understand what you own and know it better than anybody else. So, we really focus on the quarterly earnings, but we don't use that to make investment decisions.
Gotcha.
We focus on the long-term trend of those quarterly earnings, because that's what's important. If a company has a bad quarter, okay, why? Why is the stock down 5% when they beat? We have to figure out the why all the time. And maybe it was a one-off tax issue. Looked like Netflix yesterday had a one-off tax issue with Brazil. They've had to pay back to 2022 and a dispute of taxes, and they missed earnings. Okay, the stock was down. I think it's still down today, but investors of long term will probably look through that if they own Netflix. So we do monitor earnings quarterly, guidance, sell side, buy side reports, and we have to be able to formulate all of these data points into our own opinion, because we're the decision makers at the end of the day. I have my set of coverage, and I like to know that coverage better than the person sitting next to me, or the person on the other side of a report that is bearish and I'm bullish, or if I'm bearish and they're bullish. I need to understand the why. Why. And you have to look at it from the top down. You know, you have bull, bear, neutral. You got to be up here, and you have to be able to understand both sides and make an educated decision based on the data that you have at your fingertips.
Yeah.
So yeah,
It sounds like you're really taking an approach that's both unemotional, but you haven't made up your mind before you make that investment decision. So it's
definitely.
not like you're going in trying to figure out how do I look at Broadcom or Netflix or
Mhm.
whoever in a positive light. You're looking at, hey, should we look at it in a positive or negative light, and then doing the research
Yep.
to really get there.
Yeah,
Um,
definitely.
no, that's fantastic. Oh, I know too, we're not just buying one or two individual companies and holding them in
Right.
portfolios. We're really looking at diversification. How do you guys view diversification in portfolios whenever you're crafting these portfolios
Mhm.
in totality?
Yeah, I mean, I think portfolio weightings in the longer term is what will drive your portfolio's returns, right? I
Yeah,
mean, it's kind of obvious if you have a stock at 6%, that does bad, and you have a stock at 1%, that's up 200%.
yeah,
We know which one's going to be driving those returns. So what we try to do is position, our highest conviction at that moment in time, 4 to 5.7% max. Um, and we think that's a fair weighting, and then we can trickle all the way down to 1 3/4.
yeah,
We'll hold around 26 to 30 businesses. We have 3 people in coverage, so
yeah,
it works out. Um, and we want to be diversified, but we don't want to be over diversified.
of course.
I think over diversification is a killer. I mean, Buffett says it all the time. He doesn't.
Yeah,
I don't even think Buffett believes in diversification at the end of the day.
yeah, yeah,
Because he had what 46% in Apple at one point.
yeah,
He those top 4 for him make up like 80% of his portfolio.
yeah,
So it, portfolio weightings can be subjective, and it all comes down to you know, risk tolerance, which Matt can definitely
yeah.
cover that more. That's why we have our model menus. Uh, and then, it comes down to what is your conviction in the underlying security?
Yeah, definitely. So we want to take advantage of maybe some concentration, not owning 1,000 or 2,000 different stocks,
Right.
so that we can take advantage of the upside growth in those 25 to 35 companies
Right.
or so. But at the same time, we don't want to be so concentrated that if a company does drop by 20, 30, 40%,
Yep.
it really affects the
Yeah,
portfolio. So
definitely.
it's like, okay.
And there's this thing like if you have your portfolio and tech's doing well, which it has,
Yeah.
that will drive the performance. Then if you own, energy and life sciences or healthcare, that's kind of been a laggard recently.
Yeah.
So that's why you got to focus on the long term, because it could be 1 to 2 years of underperformance where certain areas in your portfolio aren't working.
Yeah.
And it happens all the time. I mean, I think since 2022, around 30 stocks are responsible for around 70 to 80% of the overall return in the S&P 500.
Yeah.
And you see that in the concentration.
Yeah.
The concentration isn't bad in my opinion, because they've earned that with the economic value add that those companies put out there. And you definitely want exposure there, but you also want exposure to stuff that's not doing as well, that is still real businesses that are generating free cash flow, that are going to return that to shareholders. So, there's a lot that goes into it, and you have to be able to break it down piece by piece. And it's like a puzzle.
Yeah.
You have to put the puzzle together.
Definitely. And I think a couple different things from a financial planning standpoint, as Chris touched on. Back in April, we had clients calling us, and remember this in 2020 and in 2022 when we had market pullbacks saying, hey, I see the market going down. I see the market going down. Please sell, pull out. And a part of our job as financial planners is to help the clients decode these global signals as well, and coach them through the pain that they feel, because our portfolios aren't doing better than they are. We're also invested as investors,
Right.
going down as well. But we know on the other side that portfolios and markets do recover, and we just have to sift through the noise ultimately, because if we would have listened to our clients when they asked us to sell in April, then they might just be permanently down 10, 15, 20%,
Yep.
when they would be up, what, 15%
Yep.
now at
You
this
gotta
point in time,
make that up.
depending on the asset allocation, the type of portfolio that they have, of course. But a lot of that in when we really stretched it out long term, there's a really great study that was done that just by missing the few best days in the market over a 35 period, you sometimes can miss tens and 20s and 30% of return overall. So a portfolio that may have grown to $1 million or $2 million sits at $700,000, $600,000, and that can really prevent you from accomplishing the goals that you set out to with that capital appreciation.
Yeah, I mean, I was listening to a podcast the other day, and if I remember correctly, 16 of the last 17 years, the Nasdaq's been positive.
Yeah.
So fear did not make you money.
No. Part of our job too is determining risk. Whenever we look at risk overall, we want to figure out how much risk we believe you should take on and match that with how much risk you're desiring to take on as an investor as well. Just as Chris touched on a bunch of different times, we want to make sure we're investing in quality investments, quality companies, not speculative. To a certain extent, of course, there is some speculation on we don't exactly know the future. So there's speculation in that sense, but no speculation in we have no idea what this company does or where they're going and what they're about, how their cash flow works. We want to make sure that you have a plan for ultimately matching your goals to how we're going to get there. So that's figuring out how much risk, like I talked about, you can take on, how much risk you're wanting to take on. But Chris, I want you to talk about a little bit too. How do you look at different models and how we have many different investment models? How do you guys view those in catering towards goals that people might have? Talk about maybe some of the models that we have a little bit too.
So we run a few different models, and the first one I can kind of touch on is our dividend appreciation model, which it's the same approach as any other investment. However, we're more focused on the yield that the company can spit out for us and the total shareholder yield. So not just the dividend yield, but the total shareholder yield, because we want that capital appreciation overall, not just the dividend appreciation. So it's more of a value tilt. We do have some growth, stuff in there,
Of course.
but it's definitely got a value tilt. And when I say value, we're not looking at, when people think value, they think 6 times earnings.
Yeah, really low PE. Yeah.
Value is subjective.
Gotcha.
There is value in buying a 30 PE stock. There's value in buying a 10 PE stock.
Yeah.
It's all relative to growth expectations. So we want to buy companies that are trading, kind of below that growth expectation, and then they grow into the growth expectation.
Yeah.
And that's kind of how we go about the overall process to an extent. But the dividend portfolio currently yielding about 3.5%, 10 years yielding 3.994%.
Yeah.
It's back and forth. And you're going to get that capital appreciation as well. So we think it's a pretty good model for, IRAs or someone who's wants a little less volatility.
Yeah. In
their portfolio. Yeah. And then we have a model that is called the unconstrained equity model, which is essentially, pedal to the floor growth.
Yeah.
But again, we're not buying speculative assets in it.
Of course.
It is levered more towards tech right now, because tech is what's been working.
Yeah.
So, 50% of it is technology companies, and the performance has been very well. There are, some other companies in there. We run a more concentrated approach in that strategy where we could go all the way up to 10% of the holding.
Yeah.
We could flip 100% healthcare if we wanted to. And it's one of those models where you shouldn't have to worry about taxes. We're just focused on, that long-term performance and outperform the benchmark.
Yeah.
And then we have our multi-asset and individual securities models, which are the core bread and butter, where, we have in the individual securities model, we have all the way up to 100% securities, which is 26 to 30 stocks, all the way down to 15%.
Yeah.
And then 85% fixed income.
Yeah.
And
we have models that are 100% fixed income as well.
Yeah, exactly. Yeah.
Too.
And our approach is the same for those. We're looking at good quality businesses, and we're looking for growth.
Yeah.
And a client who has a risk tolerance, or maybe somebody who's in their 70s maybe wants 65% equities.
Yeah.
Or maybe they'll stay in 100% equities because their kids will inherit the account, and then the step up in basis if they've been here a while. And then our multi-asset model has the same individual securities within it, but then we also have mutual funds where we could get international exposure, where we're not as competent in those areas.
Yeah.
We're domestic competence isn't domestic equities.
Yeah.
With equity income, selling cover calls, mutual funds, selling cover calls against the positions for income, or a dividend appreciation mutual fund within that multi-asset model where, it has a little bit of everything in it and kind of buffers you in different market scenarios.
Yeah. Fantastic. And there's tons of others, I know, portfolios and models that we have that not necessarily your team, but some of our sister
Mhm.
companies have as well that can deal with really unique situations like over concentration in stock,
Right.
looking for something very unique. And that's something we can talk about, but it all comes back to, I think, as you mentioned a bunch of times, your financial plan. What type of goals are we looking to achieve? Are they goals in the next 3 to 5 years? Are they goals in the next 20 or 30 years? And what type of ride do you want to take to get there as well? Do you want the bumpy ride? Do you want the roller coaster, or do you want the smooth, easy ride?
I'm here for the bumpy
Yeah,
ride.
for the bumpy
I like
ride.
the bumpy
Yeah.
ride. I'm young, the
Just
bumpy ride isn't.
yeah. Chris, maybe a 75-year-old or 80-year-old client might not feel the same way. So luckily we have strategies really for everything across the board. And as we to talk about DIY investing, that's really what you guys are here to talk about, understanding day trade or doing it on your own. What does that mean? Chris, when you look at people who do it themselves, what mistakes do you often see when they're crafting their portfolios, picking the stocks, picking the mutual funds? What are the biggest offenders on your sheet?
Emotions,
Okay.
headlines, Motley Fool headlines. This stock is the next 10 bagger. Like
Yeah.
stuff like that appeals. It's like media,
Yeah.
financial media specifically too, and global media is what the target audience is trying to appeal to emotions.
Yeah.
I mean, we have every other year a new article comes out on someone expecting a 80% crash in the stock market.
Yeah.
Get out now. Okay, the probabilities are not in your favor. Historically, the probabilities are very out of your favor. And the biggest mistake that the DIYs definitely do is they have full-time jobs elsewhere.
Yeah.
Right? I mean, the engineers, the doctors, the electricians, the plumbers, the lawyers, I can't remember if I said that. They have full-time jobs that they're professionals in.
Yeah.
We're professionals. That's why our industry exists. We're professionals here and we want to bear the stress for you.
Yeah.
You kind of get numb to the stress of volatility eventually, but we will take the gray hairs for you. That's our job. And the DIY, I think there's a big difference of, people want to compare to a benchmark. Let's just say the S&P 500. The assumption that you're going to invest 100% of your assets in the S&P 500 and then that's it is vastly not correct.
Yeah.
Like it's the opportunity cost between having a diversified portfolio of 30 stocks, the cash flow planning, the fixed income planning, the tax planning, versus having 100% of your money in the S&P 500, which you pretty much would be tailored towards the top 10.
Yeah.
So it's more risky, if anything, at this point, in my opinion. That's our job, is to minimize that risk involved with doing it yourself. But over trading, lack of discipline, having a core set of principles, and being unemotional about the financial decision. Money and emotions.
Yeah.
They're very tightly correlated.
No, yeah, definitely see so many emotional mistakes. We touched on that earlier a little bit with seeing people jump out of the market maybe at the worst times behaviorally, and then they don't get the chance to recover those. I mean, plenty of times we see that, as well as a financial planner, as an advisor, we see so many people come in here who are DIYers, and that's okay, maybe in some case scenarios, but they don't often have a plan. They don't have an investment strategy, investment policy statement set up. They don't have a retirement plan that also works with their estate plan, their tax plan, their insurance plan. Really, as investors and financial planners, we want to make sure that all of what me and Chris have talked about all work together and mesh together in harmony, walk and talk together, if you will. We also find ourselves as advisors, and I know you guys do this maybe indirectly as well, helping out behaviorally, just as you talked about. People really are emotional when they react to their investments because money is a really important thing to people. We get that. It accomplishes so many goals. It takes away stress. It adds stress to our lives.
Yep.
So whenever we help and talk to clients, we're often acting as behavioral coaches in a sense.
That's right.
helping
Oh, yeah.
people avoid major mistakes that fortunately we've got to see and witness other clients go through, whether it's a unique circumstance around a financial planning thing, or if it's the common circumstance around, oh my gosh, the market's pulling back. This is so scary. I have to pull my money out. There's somebody calling for a huge recession, worse than the great financial crisis or a Great Depression style recession, as we hear, it seems like every 6 months.
Yeah. Yep. I mean, Warren Buffett, I'm pretty sure majority of you have probably heard of this guy. He's pretty good at what he does.
Yeah.
And basically markets are up 75% of the time and down 25% of the time. It's probabilities. And I think people are so focused on the day-to-day headlines and that incite fear in people that they forget about the probabilities.
Yeah.
And we think that that's an edge.
Yeah. Yeah. The markets take a drop, usually 20% or so, just like we saw in April, every 3 to 5 years. And then once every 10 years or so, they have some sort of recession. So we as planners and as investors can recognize those things and realize that it eventually comes back. And that's too where the competition comes of asset allocation, figuring out it's okay too if people have a really hard time sleeping at night whenever your portfolio is jumping around. But that also, from a financial planning and advisor standpoint, we want to make sure that then we match you with the correct portfolio. And that might include adding bonds or fixed income into a plan, or adding some form of guaranteed income, or figuring out how to best structure so that you can stay on the right path and that we can accomplish the goals that ultimately you've laid out in your plan that we work to accomplish together. Really bringing it all together. I know, kind of summarizing what Chris has said and what I've said. We really want you to stay focused on your long-term goals. Ultimately, that is the motivation to stay invested. That's the motivation to figure out how to structure your portfolio. We want to constantly revisit your plan, especially if you're stressed out about your investments. If you're wanting to try something new, we want to make sure that something new or that change in investment strategy matches with the plan that we've set out, as well as partner with professionals like Chris and myself to do so. I know, Chris, you made the comment earlier about not maybe having the time, especially if you are a professional worker or you're doing this stuff all day. We talked about this earlier. We like to akin the entire investment picture, not just to doing a house project on your own. It's not as simple as installing a new toilet or installing a new hot water heater on your own. We do both ends of the job. Chris, I like to think of him more as the engineer, the guy who designs maybe the hot water heater behind the scenes that you don't really see, and me as an advisor in our team as the one who installs it as the plumber. So it's not just you acting as one piece or another. You really have to have two people to deal with the analysis of the investments in stock market, as well as the financial planning and the upfront installation of those investments really in the end. I don't know if you have any other comments on
No, I mean,
that.
look, we're within the same industry and we have two totally separate jobs.
Yeah.
I mean, I'm
Yeah.
not a planner. I'm not an estate planner. And vice versa, equity
Yeah.
analyst. I mean, you got to be 100% focused on what you do.
Yeah.
And that's what we do here.
Yeah, very much so. Fantastic. Hey, thank you everybody for jumping in today. We'll go ahead and answer some questions that came through the chat. The first question that we had, we always get questions about this. What is the best way to invest in cryptocurrencies indirectly, that is with a trusted custodian? I don't know if you want to jump into that first and foremost.
I don't have a direct answer for that. I don't invest in crypto personally, nor do we have client portfolios in crypto. I know there are ETFs out there that do it. I do not know how the ETFs operate structurally and fee wise. So definitely probably reach out to your advisor and we can find an answer for that.
Yeah.
For sure. We have the resources to do that.
We definitely do.
But personally, we do not invest in the crypto.
Yeah, I'll echo what Chris said, kind of same thing. Definitely talk to your advisor. If you do not work with an advisor currently, always happy to chat with you personally as well. My information will be at the end of this session here on one of the slides. You can give me a call, shoot me an email. We can talk about it just to see if it makes sense in any form or fashion. There are a lot of custodians that have them now, some of the pretty big custodians, whether it's or mutual fund or ETF managers, the BlackRocks of the world, the Fidelity's of the world, the Charles Schwab's of the world. So yeah, I would say first talk to an advisor to see if it makes sense. And then secondly, maybe if it does, reach out to a custodian that you work with. I'm sure they have different options for you there. We got a question about AI bubbles. So that's been, I know we touched on that a little bit here early in the presentation. A lot of the stock prices of some of the big AI companies aren't supported by their current profits, is what this comment says. I don't know if you have any comments on that. I know there's a lot
I
of
would
speculation
disagree.
there.
Yeah, I definitely disagree with that. I mean, Google, Nvidia, AMD, they are backed by their current profits and their free cash flow. I mean, if you want, I don't know what the future estimates of Nvidia is, but I mean, they're sitting around 27, 26 times earnings. I mean, it's not unreasonable if the earnings are durable. I think people are focused on nominal price performance versus what is backing that nominal price performance. Just because a stock is at, okay, back up. If the S&P is at all-time highs, nominally they are, that doesn't mean they're at all-time highs valuation wise. So if you're at 22 times earnings, but you're growing low double digits, it's not super bad.
Yeah.
I mean, your short-term IRR might be unattractive, but longer term, that's not unreasonable. So a lot of the mega cap companies outside of Tesla are reasonably backed by their profits. However, the point that I will make is the capital expenditures in the data center build out. It's all going to come down to what is the return on that invested capital. And if you're a long-term investor, that timeline is more like 10 to 15 to 20 years.
Yeah.
Whereas people are like, now, living in this on-demand economy, like, what are your profits from it? And it takes time for these things to work.
Yeah.
No matter what you're investing in. Investments you don't just invest in something and go straight up.
Yeah.
It's profitable. It takes time to implement it and get it off its feet. So, I wouldn't call it a bubble, given that those top companies are backed by pretty strong profits because they do have very profitable businesses.
Yeah.
To fund all of this. Whereas back in, the original like tech bubble, and all the way back to tulip mania, there was nothing backing tulips outside of the perceived valuation on a bright purple and green
But
tulips.
yeah,
I'm going to buy a house with that.
That was
that
1800s or
yeah,
so.
that's what happened. I give you 5 of these and I get your house, and then someone is just like, I don't want a tulip anymore.
Yeah.
It just crashes.
Yeah.
That's not necessarily what is happening with large cap tech, because outside of the capex spend, they still have very profitable businesses. You use Microsoft every single day; it's ingrained in all of the enterprises. We have Teams right there,
Yeah.
PowerPoint, and so bubble is a strong word because I think the time horizon is too short right now.
Yeah.
Normally, you won't know it's a bubble until it pops.
Yeah, exactly. And it's always hard to predict, and we're not going to stand. But it also comes back to that's why we're also, while we don't view it as a bubble, there is risks associated with it. And that's why we diversify, not just in tech, but also have healthcare, consumer essentials, consumer discretionary, and all the other things across the board.
Right.
No, and I think, like you touched on in the early 2000s, while there was a lot of bubbly components to it, you had a lot of companies that were unprofitable or had zero profits doing all this build out for the fiber optic cables. The one thing that's nice is these companies do seem to have good free cash flow to a certain extent, and yeah, are backing all this stuff. And the fiber optic cable eventually got used to in the mid 2000s. So
took 10, 15 years.
Took 10, 15 years, and that's why some of this stuff takes a full business cycle or two to really get in use and get the profits out of it. And that's why we're long-term investors.
Yep. And to kind of build off of that a little bit more, energy usage.
Yeah.
I mean, so if you want to kind of get a little insight into the process that I utilize is, okay, tech capex is cool, those stocks are up a lot. How are we going to build out the energy and the infrastructure to power all of that?
Yeah.
I mean, look at Cummins company. I mean, all-time highs.
Yeah.
Big power generators. I mean, nuclear potential. I think there is a bubble in some areas of the market that, like a company like Oklo, that is a story for another time. Zero revenue, $20 billion market cap company.
Yeah.
Why? I don't know. There's a lot of bets in nuclear, and that's what it is right now. It's just bets.
Yeah.
That area of the market is froth.
Yeah.
Certainly agree with that. The area I don't agree that there's froth is the real large cap tech companies and the semiconductors like a Lam Research, or even a Keysight Technologies that does the networking equipment and testing. It's markets are a puzzle.
Yeah, yeah. And even like we talked about Broadcom and AMD and stuff that we own in portfolios as well, does have other business backing outside of AI stuff as well. So yeah, a lot of these companies have other cash flows outside of just the AI. Jumping on to our next question. We get a lot of questions about Magnificent Seven. I know you touched on that earlier, maybe Mag Six, depending on how you view Tesla, I guess in the end. But more of a joke than anything else. They seem to have really high performance. Why not just invest in the Magnificent Seven?
Yeah.
Just only do that.
Why not just buy Carvana? Why it's up more than Nvidia in the last 5 years.
Yeah.
Pretty sure still. Yes. Why not buy Build-A-Bear?
Yeah.
It's up 2,200% in the last X amount of years. It's easy to point and say, why not just buy that? I mean, they're Dillards the last 5 years. But those three stocks have outperformed pretty sure these stocks.
Wow.
There's pockets of the market that are investable that has nothing to do with technology. You could just go and buy the Mag 7. There's an ETF for that. Or just buy the S&P. But you run the risk of concentration.
Yeah.
And some people are okay with that. I run that kind of concentration, just my risk tolerance. That's just how I am. But there's other companies out there that do very well, that return cash to shareholders, industrials, all the HVAC companies that are benefiting from all of this, some of the nat gas. I mean, even Kinder Morgan ended up re-rating because of their pipelines and the nat gas that's going to be used in data centers to cool it.
Yeah.
There's a lot of different parts of the market that can do well.
Yeah. Yeah. It's hard to hindsight's 2020, of course. We'd all love to say that
I'd be retired.
We just invest in the Mag 7 and leveraged it and did the whole bit and take on all the risk, but we obviously don't know what's in the future. And if any of you guys have a crystal ball, me and Chris are willing to buy it off you at a very high price if it works well. So last question here is more around taxes. I know this is the time of year often we are doing some tax strategy with taxless harvesting and stuff, but how do you and your team think about taxes, if you do? And I can also touch that on a financial planning standpoint. How do we deal with taxes in portfolios? Aren't they just inevitable, and we just not avoid them?
The infamous T word.
Yeah.
So they are inevitable. You have to take an approach where you trim. You don't want to let things run too much where it becomes 8 to 10 to 12% of your portfolio and you haven't taken any gains, because in a market drawdown that can hurt you.
Yeah.
It can benefit you just as much as it hurts you.
Yeah.
Vice versa. So we think that keeping a balanced, budget for taxes and allowing us to manage the portfolios how we see fit, because we're trying to do it on the client's behalf.
Yeah.
Right. It's our fiduciary goal is to manage that to the best of our ability. Letting a company run to 20% isn't managing it to the best of our ability, even if we like the gains.
Yeah.
But it works the opposite way too. But taxes are inevitable, especially when the market's done what it has over the last 3 years, pretty much straight up and to the right.
Yeah.
Then that's when it gets very difficult, because you run into issues of, you can speak more to this, but clients that take Social Security or Medicare, whatever, and then they can't realize this amount in a year, and then we go over it, then they don't get that, and that's where they specialize here very well, is being able to manage that.
Of course.
So
yeah. So it's a balancing of risk and taxes. Obviously, we want to make sure as fiduciaries we're not allowing clients to take on so much risk and just totally just to avoid taxes in one form. But at the same time, taxes do play a big piece in managing portfolios and the ultimate returns over a long time. And as financial planners, just as you touched on, there's lots of different ways that we can help out manage taxes, from setting a capital gains budget to figure out how much we can realistically take in a year so that we're not bumping into certain limitations, especially when you get to that 63 to 65 age and beyond, so that you're not running over and getting charged more for Medicare Part B and Part D, as well as bumping into certain brackets with net investment income tax and all this other stuff that can come about. We want to make sure that we're very, very mindful of taxes, but also very mindful of their risk tolerance as well. And there's lots of different things we can do. We have portfolios that use different types of bonds with municipalities that are more tax efficient than corporate bonds. And maybe that too is a conversation of using asset location rather than just asset allocation, making sure our really risky, high frequency of trading, maybe more actively managed, like our unconstrained equity, where you guys are ignoring capital gains in totality just to get the highest growth, using that in more tax advantaged accounts where we're using more tax efficient strategies and brokerage accounts where we're forced to pay those taxes on a regular basis.
And the flip side of that is, if you're paying taxes, you made money.
Yeah, exactly. It's hard to say that's a bad sign. Usually that means things are going pretty well generally, unless we can avoid them in different techniques, which there's ways to definitely deal with taxes from a financial planning standpoint. And it's very individualistic how we do that. And that comes back to making sure your investments, your risk tolerance, your taxes, your estate plan all walk and talk together over.
And from our side, we're not gonna hit 10 out of 10 on every single stock we own. Not every single stock in the portfolio is going to be up every single year. You're going to have some losses. So, that's when we get together and we kind of look at it like, okay, is it worth taking a loss in this company at the end of the year for tax loss harvesting to lower some of the capital gains? Well, we do that as well.
Yeah, that's a good evaluation process. Also, generally on an individualistic standpoint, sometimes it's on a company-wide standpoint about this time of year as well. Fantastic. Hey, thanks everybody for joining us here today. You can watch the recording of this if you jumped in late at www.fortpittcapital.com/blog/. You can view it there. You can also view a bunch of old past webinars. You can fill out forms to have somebody like me contact you guys. We're always happy to reach out, have a conversation, see if Fort Pitt's a really good fit for your financial planning needs. Here's my contact information. Again, my name is Matthew Villers, a certified financial planner. You can email me at mvillers@fortpittcapital.com, or you can give us a call to our office at 412-921-1822. Here are some of our disclosures. You guys can read those if you want to. Thanks for joining. Really appreciate it. Take care. Thanks, guys.